Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle, and we have a very notable guest with us today in the form of Terry Smith, the Chief Executive and Chief Investment Officer at Fundsmith, best known for the Fundsmith Equity Fund. Terry, many thanks for coming on. How are you doing?
I'm fine, thank you. You?
Very good, yeah. Busy times, as you said, lots of results earlier in your portfolio.
Lots, yes.
So let's kick off with, I suppose, one of the kind of big topics of the last kind of year or two. There's been lots of criticism levelled at the kind of so-called Magnificent Seven stocks, or recently I saw the Monaco Super Six and so on. But they do appear very prominently in many portfolios. And we've noted before that Fundsmith Equity has taken on kind of more exposure to Microsoft, Meta, Amazon, Alphabet, and Apple as a kind of broad cohort in the last few years, which kind of brings me to ask, when you are a large fund looking for quality companies, as your team does, is it now becoming kind of inevitable that you'll gravitate towards these kind of stocks? And is that going to make it harder for investors to distinguish between what you do and kind of all the other funds that hold those very well-known names?
Well, the short answer to your first question, which is it inevitable you gravitate towards them, is yes, really. They're very large and they are a very large part of the index return. So assuming for one moment that they go through our pretty stringent filters with regard to quality, and not all of them do, then we would be foolish to disregard them, I would say. And indeed we don't, as you say. But is it possible to distinguish between us and others? I would say yes is the answer to that as well. Why? Well, you named 5 stocks there. You said, Microsoft, Meta, Amazon, Apple, and Alphabet. Well, that's not 7 or 6, it's 5. So we don't own the other 2. We don't own Nvidia or Tesla, and I don't think we ever will own Tesla. I just don't think it's feasible for us to get Tesla through the quality parameters that we have. We could muse on various people's prognostications about the fact that, it's not really a car company, but it looks like a car company. And car companies, as you probably may have noticed, are pretty terrible, really. Recently they've been terrible, but they've always been pretty terrible, actually. So don't know that. And Nvidia is a bit of a jump ball, I must say. We can discuss that if you wish, but we don't own any, but that's what. And we don't actually own any Amazon now either. So out of the 7. We only own 4, and even then, we can back off from that. We own very little Apple. Apple is 1% of our portfolio, and a tiny amount of Apple. We started buying it about $125 a share, thinking that we would get an opportunity to buy a lot more because we thought the fundamentals would be weak for a number of reporting periods, sales in particular. And guess what? We were right about the fundamentals and the share price doubled. So we haven't got very much Apple. So we're kind of, we are pretty underweight in these stocks. So somebody who's out there who's doing an index hugging, we're quite distinguishable in that regard. The other thing is we're quite distinguishable in other regards as well, I would suggest. We own quite a lot of things that dedicated followers of fashion with regard to the Magnificent Seven or the Super Six or whatever you want to call them these days, are not going to necessarily own. They're probably not going to own very many of the consumer staples like the Procter & Gamble's and the Unilevers of this world. They probably don't own too many industrials either, like Atlas Copco or Otis, or very many healthcare stocks like Stryker and Coloplast. So I think we're pretty different actually.
And you have kind of briefly touched on this recently, but Nvidia, everyone's wondering who doesn't own Nvidia. Is there anything that would kind of make that more compelling for you? Is that one you would kind of consider?
Well, it's one that's in our investable universe, so I could, technically within the remit of how we operate, go and buy it today if I wanted to. And we have had, meetings of the team in recent times to discuss whether we should. I guess one of the things that we're seeking when we invest is a high degree of predictability. Nothing's totally predictable, but a high degree of predictability. And things that produce sort of very fantastic results, it's up like a couple 100% the last year, are tremendous, but are they predictable? Before Jensen Huang got up in May last year and said what he said about the demand for their chips and AI, I don't think too many people really thought that this was about to happen. So it wasn't all that predictable, was it? And is what's going to happen next any more predictable? Well, I'm not sure it is, because Nvidia's done two, another modern term that people use, pivots in its history so far, where it's changed from making or leading with one sort of chip to another sort of chip, from into gaming, into Bitcoin, now obviously into GPUs for artificial intelligence. And I have to say, they've done it very well. But two things are really quite worrying about it. One is any business that has to make such fundamental changes worrying, because sooner or later you get one of those things wrong, is my experience of it. And even when they got it pretty much right in history, on two occasions the stock went down 80% whilst they were in the course of doing it. Well, that's quite alarming, really, isn't it? It's quite difficult to imagine keeping your cool and keeping your position whilst all that's occurring. It's obviously a cottage industry quoting Mr. Buffett, but I've got one quote that I don't think anyone's ever used, and one that almost more than any other accords with what we try to do, which is we're trying to produce a high certainty of a good result, not a chance of a superb result. Right? That's not what we're trying to do here. We're trying to give you something which over time should outperform the index a bit, with risk adjusted a lot, because we don't think there's a great deal of volatility in the portfolio, and not something which, well, it might go up 100%, but then it might go down 80%. It might go up 200%, but it might go down 80%. And it's like, wow, that's not what we're doing or seeking to do. But we might be wrong. I mean, one of the things we totally accept, I in particular totally accept, is we're wrong from time to time. Yeah, that's right. We're unlikely, in my view, to fail because we don't own the greatest stock out there.
Yeah.
But I think we're quite likely to fail if we start owning some of the worst stocks out there.
Yeah. Briefly sort of dwelling on Nvidia, it was really interesting. Was it last year? Maybe it was earlier this year. You were talking about the difficulty of spotting, I suppose, whether first movers would stay dominant, and you listed many examples of companies where they kind of fallen by the wayside. I suppose the kind of AI, some people might call it bubble or boom or whatever, it's kind of muddying the waters a lot. To what extent are you kind of considering the AI theme at the minute with your current holdings? I mean, I suppose you have quite a few names where that is kind of part of the business model. How is that affecting your thinking?
Well, I mean, we do follow it, and we have quite, as you quite rightly say, we have quite a number of companies which are beneficiaries to one degree or another. So, say Microsoft, Alphabet, Meta are all pretty clear beneficiaries, certainly of the current trend, fad, hype, whatever the hell it is, and probably even of a use case as well. If you're looking for something where you can see an early practical application, digital advertising looks quite likely. And in the case of Amazon, of course, providing data centers and cloud services, you've got to actually make this operate on something. So they're all quite good beneficiaries. What I like in companies is when they are supplying something to the end consumer more, not when they're supplying something earlier on in the value chain. And this applies, I think, in AI or technology, just as it does in the consumer area. And the best way I could put it is this: awful lot of time over the years, people have said to us, because we've got a consumer staples and a consumer discretionary portion of our portfolio, they said, but it's pretty dangerous to be close to the consumer in a downturn, isn't it? I say, you're absolutely right. It is. There's only one thing that's more dangerous than being close to the consumer, and that's not being close to the consumer. Because when you get a consumer downturn and someone like Unilever or Procter & Gamble sales go down 5 or 10%, which is not funny, but it's not the end of the world. Guess what happens to their suppliers of ingredients and components and capital equipment? They quite often have 100% downturn. And I feel that Nvidia is clearly at one end rather than the other end of that particular spectrum.
Yeah, very interesting. On that note, let's turn to some of your sort of consumer staples exposure. You recently made quite an interesting point about selling Diageo, partly because you thought we might be in the early stages of seeing the effects of weight loss drugs, one of those being simply that people are deciding perhaps to drink less. Is that kind of a concern that also colours your view on consumer staples more generally? Of course, you own some names like Unilever. How is that kind of feeding into your thinking?
Yeah, no, it is colouring our thinking in general. However, if you analyse the situation, and obviously at the moment we've got very sort of incomplete fragmentary data, so the executives of these companies do and can either say or hide behind, however you want to characterise it, the mantra of, well, it's too early to tell kind of thing. However, in the early going, I can tell you this: where they look at what people don't do as a result of the consumption of the use of weight loss drugs, alcoholic beverages is one of the very first things to be affected, and to be affected largest. There's absolutely. Does it have widespread effects? Yes, it does. Yeah, I mean, these basically suppress your appetite, right? But one of the areas of appetite that's most suppressed is alcoholic beverages. There's no doubt about that. But it does affect other things, and yeah, it does affect our thinking on it. Not very much on something. I mean, these are, when it comes down to it, people are very often trying to get a big wide brush out and consumer staples. Okay, that's all a problem. Unilever doesn't have that much in food anymore. Unilever sold its spreads business and it's sold its tea business. Its biggest consumer brand now is Knorr. Now, if Bouillon's affected by weight loss drugs, it would be rather shocking, I think, since it mainly consists of some powder and some water. So, I mean, Unilever is now more a health, well-being, beauty, and household cleaning products business than it is a food business. If you're looking at consumer staples, clearly, Diageo will be at one end of this, I think, in terms of effect, and Unilever would be quite close to the other end of it. I mean, Procter & Gamble, which we own, I can't see how it would affect it at all, unless you think that cleaning the kitchen is something you do less frequently as a result. I mean, it doesn't have any food. Its very last food brand, Pringles, was sold to Kellogg some time back. They don't have any food.
Yeah. So you try, I guess, to kind of diversify within your staples exposure and.
Yeah, well, not to get in the areas which we think may be in the firing line. Clearly, alcoholic beverages looks as though, from the early statements, I mean, I think alcoholic beverages have got a few things that are problematic at the moment, and the companies individually have got a few things that are problematic. I mean, it's possibly got the early stages of weight loss drugs. Secondly, it had a great pandemic. People drank more when they couldn't go out, which is perhaps unsurprising. So we've got down to and Generation Z or Z for any American listeners drinks less. I mean, they just do, right? Different generations use different things in different ways. And then you've got, people say it's not the same, and it's not the same, but it is still there. The legalization of cannabis is another thing to take into account here.
I suppose sticking with the kind of weight loss topic, how much does that feed into your kind of backing of Novo Nordisk? What is your general view on the kind of outlook for that company now?
It's not why we bought Novo Nordisk. We've owned Novo Nordisk for coming up to 6 years, I think. If you can go back 6 years and find weight loss drugs in any of the reportage on it, let me know, because I don't believe there was any at that time. We purchased Novo because we thought it had a very unusual, possibly even unique, although that's obviously a slightly overused word, attitude to drug discovery. It's a company, and we've got a bit of a soft spot for companies like this. It's controlled by a foundation which represents the founding members of the company, and it has a real long-term view, and it had a real radical approach to drug discovery, which was, we thought, interesting, and to many other things. Its approach to accounting was unusual in relation to drug companies, insofar as it was straightforward. Didn't sort of attempt to X out of the earnings any unpleasant negative stuff, like litigation and so on, or amortization of intangibles, or any of those sort of things which other drug companies were doing. And so we bought it actually because of those unusual features, not because of weight loss drugs per se. But then weight loss drugs were something that emerged from that process. And I suppose the way I would put it, before we perhaps go back, if you want, and deal more directly with weight loss drugs, is I wouldn't write off Novo Nordisk from coming up with some other blockbuster discovery at some point. People seem to think, well, it's the leader in weight loss drugs. I don't know whether weight loss drugs will succeed. I don't know whether it will be the leader if they do succeed. I think if there is any hint of any of the forerunning things, the stock market will have a hissy fit. There's no doubt about that. But why do we assume that they can't discover something else, given that their approach? That's what I would say in relation to thinking about Novo. It's an interesting company. Anyway, on weight loss drugs, look, I think that they work, notwithstanding all the hand wringing from various naysayers around there about the thing. I think they work on a much wider basis than simply dealing with diabetes, which is what they were developed for, or obesity. I think they are clearly going to work on a much wider scale. I mean, bear in mind, I think Novo only has Wegovy labeled and licensed in, I think, 9 countries at the moment. And it doesn't include countries like Mexico, for example, which is, from a statistical standpoint, got a weight problem, or large parts of the developing world, very large parts of the developing world, which have got diabetes, stroke, weight problems out there. Look, there's an arms race going on. Everybody's trying to develop it. There'll be more failures than successes, is my guess, amongst the people trying to develop them. But the thing that I think may keep them ahead is three things. One of them is having gone early in this, being the first mover, and having the data to go on file. They have a seemingly continuous program of wider labeling of this drug. So, if you develop a drug like Ozempic for diabetes, and you find in the data, on the test data, that it also positively affects people's body mass, you can't then go to the regulator. Hello, I've discovered this in the data. Do you mind if we label it for obesity? They're going to go, no, because it wasn't a controlled experiment, was it? They were all diabetic. We need you to do a test for obesity on a normal population, where some people are diabetic and some people aren't, right? So that's what you have to do to get labeled for obesity, which obviously they've done. Then, of course, they have other data, which they discovered in the course of doing it, which says it's very good for cardiovascular incidents. So it significantly cuts the incidence of serious cardiovascular incidents. But again, you can't just go, can I have a label for that? They go, no. Now we need to do this for people who are not diabetic and not obese, and see how that population fares. I think we're going to see a continual role of things here for obviously we've got diabetes and we've got weight loss, with cardiovascular. I think we're going to see it for arresting decline in kidney function and in liver function. I think we're going to see it for autoimmune conditions, things like lupus and arthritis, probably for the arresting of Alzheimer's, probably arresting a number of cancers, and to be used as a therapy for addiction, certainly alcohol addiction, and quite possibly tobacco addiction as well. I mean, one of the flip sides of the early data showing it cuts people's drinking is that might be rather good to use for alcoholics, mightn't it, when you think about it? So I think they've got a lead. This labeling may well continue to lead them to have a lead, because those other things are important. They're particularly important to healthcare and insurance providers who are looking for the wider benefits of prescribing and insuring and paying for this out there. And of course, you need to produce this stuff. If their deal goes through at the moment from the 3 production plants that they're buying, I mean, they will have, without doubt, the leading facility in the world for actually producing this stuff. And that is problematic at the moment, producing it out there. There's many a slip, as it were, but they're pretty well placed, I would say, and they are on half the rating of Eli Lilly. Eli Lilly is on about 70-something times earnings, and they're on 30-something. And so, in comparative terms, they look quite good, actually.
Yeah. It's interesting. Also, you mentioned the kind of foundation, I suppose, at the head of the company, which brings me on to another, I suppose, a broader point, which is I was kind of interested to probe a bit what you look for when it comes to kind of management teams and general structure of companies. I remember with your kind of relatively brief holding of Amazon, part of the kind of sale decision was based on this idea that they'd move into kind of grocery. And then you later said it was interesting because they said they'd do one thing, aka the grocery move, and then they didn't. So do you, I mean, fund managers often talk about sort of meeting management and stuff. What do you look for?
Yeah, a couple of things, three things. We're looking for good capital allocators. If you invest with us, you've allocated some of your capital to us. We then take your capital and we give it to these companies. And what happens is every year they've got this sort of a set of results which show how much cash they're generating, how much profit, and they've got a series of choices they can make. They can invest in the business, so they can go out and buy things for the business, basically, services or physical things. They can buy the companies, they can acquire, they can pay a dividend, they can do a share buyback, they can pay down debt. These are all choices, and of course, usually they do some combination of the above. What we're looking for is people who are good at that, can describe how they make the choices within that and get good results from doing it. Because if they are able to get a 30% return on capital and reinvest a significant portion of their earnings at that 30% return, then our investment will compound in value significantly. And that, whatever the stock market does, the stock market is just some bunch of people playing selling shells to each other. The fact is that the underlying value of our company will compound in value. And one of my views is over time, the share price will meet the fundamentals, not the other way around.
Yeah.
You know? And that's what we look for. We're also looking for a degree of honesty. And by that, I don't just mean literally not stealing, although that's quite important. But actually straightforwardness, giving, we hate companies that do 32 pages of adjustments in their earnings release to show you that the 1% growth in revenues that they had really parlayed into 20% earnings growth. It didn't. They're just excluding the bad stuff. To give you an example, one of the companies that we like, one of the managers that we liked very much was Jean-Paul Agon, the former chief executive of L'Oreal. And on one occasion, he was given what most managements would regard as a very good gimme, a lob, which is an analyst said to him, they're in trouble in Brazil at the time, L'Oreal, and the analyst said, what would the results be like if you took out the poor results in Brazil? And he said, well, why would we do that? We own it. We own the poor results. Next question, please. That's a manager that you want.
And you've said that Unilever's kind of previous problems weren't to do with the business as much as the old management on that note. How do you feel now about kind of Nike, which has had its own kind of management changes as of late?
Pretty similar in many respects. I mean, not as long drawn out as the Unilever saga was, but then we're dealing with America, where people do tend to take difficult decisions and implement them with greater ease than we Brits, I suppose, or Europeans even. And it's pretty similar. Nike is without doubt the leader in this area. I mean, considerably bigger even than it. I mean, very significantly bigger than even its nearest competitor. Never mind the sort of the startups out there or the challenges which have come into it. So it's got a great position. And it had a very good pandemic insofar as they grasped the online ordering and fulfillment nettle, if you like, better than almost any other company I can imagine. But what the manager then did was basically let go of the bricks and mortar distribution, which is clearly a mistake because, first of all, with footwear, people do have quite a strong tendency to want to go in and try the damn thing on, right? And secondly, when you start, sort of dissing your distributors, they don't go, oh well, I guess I'll give up being in business. They go and cuddle up to your competitors, and so it was clearly an error. And when we get, as we did in Unilever and as we did get in Nike towards the end of the previous regime, people coming out with gobbledygook and waffle, that they've lost it basically. And so no, it's a very similar situation. I think it can and hopefully will do an awful lot better now under new management.
On the broader sort of capital allocation point, I mean, you've spoken a lot in the past about kind of dividends, but how do you feel, and obviously this can be quite a nuanced point, I guess, but how do you feel about kind of share buybacks? Particularly in the UK market, we've seen an absolute swathe of them in the last couple of years. A lot of fund managers have generally been very positive in terms of them being accretive to value and so on. What's your take?
I think this is pretty simple. Share buybacks per se are neither good nor bad. They only create value if you are buying shares at or below the intrinsic value of the share. Basically, you can't create value by doing share buybacks irrespective of the price. I actually had a guy who argued that no, the price was irrelevant. It's clearly garbage, right? If Microsoft buy back shares at $500 a share, does that create value? Well, it's about its current share price, debatable. If they could buy at $250 a share, would that create value? Pretty likely, huh? If they bought them at $5,000 a share, do you think it would create value? Clearly not, right? And so it's only, and bear in mind, when people use lots of mantras in investment, which are distinctly unhelpful in thinking about things, they say, well, it's returning cash to shareholders. No, it's not. It's returning cash to exiting shareholders. The people who remain, who don't take part in the share buyback by proffering shares, own a larger portion of the company, but if you've given money to people at too high a value, you've basically transferred value from your remaining shareholders to your exiting shareholders, which strikes me as not a very good idea, really. So I don't think it's possible to say share buybacks, are they good or bad? It's share buybacks in what circumstances?
Yeah. I imagine you must have seen a reasonable amount within the portfolio in the last year or so.
Yeah. Yeah, we've seen a lot over time in the portfolio. It's been a feature of it for a very long period of time. I mean, there was a time when the tobacco industry was doing it on such a scale that I think that there was a racing certainty that the companies would disappear before smoking would. Yeah.
Didn't happen. Hasn't happened so far.
Well, no, not so far. Well, part of the reason is because smoking isn't disappearing. That's part of the reason, yes.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
Turning to kind of another point, something we sort of put to you earlier this year was, it's interesting, obviously you're more focused on individual stocks, but it's interesting to look at the kind of shrinking allocation to UK listed equities in the fund over the last decade or so. And you made some interesting points to us about the fact that, it doesn't matter where somewhere is listed, but you have various examples where you've kind of preferred kind of European or US competitors over UK listed companies. Is it a case that kind of UK companies aren't really meeting your quality requirements, or is there something else at play? And then another point is kind of, would you consider kind of companies in other regions such as Asia or Japan, or does that kind of remain outside of the remit?
I mean, I think this is a subject which is mainly debated very unhelpfully by people who seem to assume, amongst other things, that where a company is listed equals where it operates. Where a company is headquartered is where it operates, and that the FTSE is representative of the UK economy in some way. It isn't, or that the UK is very important. Well, obviously it is if you live there, but it isn't really. I'm sorry, it's 1% of the world's population and 2% and a bit of the GDP, right? It's not. Look, the short answer with regard to investing in UK companies versus is we really don't care very much where companies are listed. Mainly, I mean, there are certain cases where you say where it's listed in China, where we go, oh, well, that's really very interesting. I don't think I'll be doing that then, right? Because I don't actually think the governance and ownership requirements that we have can be satisfied by that. You don't genuinely own those companies, right? In the same way that we own companies in the UK or Europe or America or Japan and so on. I mean, in thinking about the FTSE, you say, is it they don't meet our quality requirements? Yes, by and large. I mean, 20% of the FTSE is in financials. We don't own financials, right? We don't own any financials. 13% is in industrials, debatable. 12% is in energy. We don't and won't own energy. 20% is in materials, so mining. We don't own anything in there. And we could go on in this regard. It's look at it another way, if I would. Leaving aside the current sort of trend, hype, whatever it is with regard to AI, has technology been an important area for returns for investors for the last 30 or 40 years? I would say so. What is the percentage of technology companies in the FTSE? 1%. The UK is a small economy in the end. It hasn't developed big sort of market leaders in a lot of critical areas. Think about drinks. I could invest in Coca-Cola, could invest in PepsiCo, I could invest in Keurig Dr. Pepper, or I could have had Britvic. Now, it's like, Britvic isn't going to go out and conquer the world, is it? I'm fairly confident about that. And being able to go outside your home market is quite important, because sooner or later, if you can't, you're landlocked. And so really getting outside of your home market is an important consideration. There are a handful or so of companies in the UK that satisfy our quality criteria, some of which we own, some of which we don't, some of which we have owned, and we've switched between them and others. But none of our switching has got anything to do with where they're listed, basically. And Unilever, which we own and have owned since inception and continue to own, is listed and headquartered in the UK. The UK is under 5% of its revenues. If you're trying to understand Unilever, you really need to focus on India, not the UK. It's kind of a misconception about what we're doing or how the market actually works in terms of people focusing upon what is obviously for them a very important subject, which is what about the FTSE? I mean, obviously the FTSE going back 20 plus years had this race to get overseas companies to come and list it, which is perfectly understandable, by the way. London Stock Exchange did that, and the companies went into the FTSE. But they did, if you recall, have a very sort of resource-centric approach. So we were really looking at mining minerals companies to a considerable degree. Well, mostly of them are never going to be great businesses, I'm afraid.
Yeah. Turning to your point about financials, you've kind of turned some heads recently saying you'd found a bank that you liked, and recently you said there were two names that might be operating in different ways to their peers, but you're kind of watching it for the time being. What would you need to happen to kind of make a decision on that, whether you would actually kind of want to hold them?
I'm going to slightly draw a veil over it because I think it will give too much away if I tell you what I'm really waiting for. But I'm waiting in one of the two cases for an opportunity.
Yeah.
For them to do something, but I'm not going to tell you what it is because then you'll be able to go and find out who it is. I mean, of course, the other thing that I quite often doing when I'm waiting with things is making sure I really do understand it. It's one thing to think you do; it's another thing to actually think about doing it live. And the other thing is to wait for a better time, maybe. I mean, I'm not sure where we are in the business economic bad debt another cycle, but it's quite possible that the opportunity to buy a bank may lie ahead of us rather than now, I would say, if we look at what may be about to happen in the economy. So there may be a better opportunity, I think.
It must be quite interesting generally for you to judge those opportunities. I mean, you've spoken in recent years, for example, about some of your maybe more hated stocks among investors doing very well, like Meta. And I suppose same with Microsoft, you've kind of held it at times when it was a less popular name. Are there kind of, I suppose maybe this comes down to your metrics, but are there kind of ways that you find it easier to distinguish whether something is a real crisis or whether something is being kind of mispriced by the market?
We tend to look at the real fundamentals of the business in terms of what it does and what it's capable of producing in terms of numbers, and try and base our decision on that rather than whether or not X or Y is a good or a bad manager, because that can change. Whether or not the people are up in arms about how they've used data or misused data, because these things do have a tendency to go away, basically. We basically try and look at the facts. So if you go back to Microsoft, we had to look at where they were in terms of their provision of operating systems and professional tools during the tail end of the Balmer regime, when they had several missteps, including buying Nokia to try and get back into the mobile race, and failed woefully in doing so. And Skype, I mean, we're talking on Microsoft Teams. Skype was a disaster of an acquisition, ironically. Looking at how people are now rating this, so we had Microsoft at that time on a 12% free cash flow yield, or putting it in PE terms, round about 8, something like that, and saying, well, what will now have to go wrong with those two fundamental businesses? Basically the operating systems business and the professional service and tools business as it then was, for this valuation to still be too expensive. What would have to happen now? And when you go, well, actually, I just can't envisage that occurring, then you've probably got something which is okay. And then after that, other things happen which make it a lot more than okay. But I mean, really, one of the things that does stand out is buying things that other people make irrational criticisms of. When we read as much online, particularly the comment sections of things in professional publications and national publications like the Financial Times, so on, to see what people are saying. And at the time when we were buying or thinking buying Microsoft, the thing that we most read was, well, it's not Apple. Well, no kid, really. Is that it? And Meta, or Facebook, as it was at the time, the thing of, well, somebody's going to start one up and overtake it. No, they're not. No, they're not. They're not going to do that. It's got over 2 billion daily users, right? I mean, this is a company which has got an enormous capital infrastructure at work here. Right? They're not going to do that. Not going to happen. Half the world's advertisers use it.
Does it seem more difficult for kind of disruptors to come through? If we talk about some of those large caps, they do seem especially entrenched. Sometimes you get fund managers perhaps clinging to them more and just feeling like, there's not so much, it's not as easy to disrupt as it was perhaps in the past.
Yeah, I think that's probably true. If we look at the sort of the leading companies in cloud computing, operating systems, mobile telephony, communications, and so on, it's difficult to see you getting much outside a sort of duopoly, isn't it? In some cases, the degree, it's the Warren Buffett thing. I mean, he was going back to the days of newspapers and so on. Why did he invest in the Washington Post? And one of his reasons was if somebody turned up and said, here's $1 billion, set up a competitor, he'd go, no, keep the $1 billion, I can't do it. It's the same with this. If somebody turns up and says, I want you to set up a competitor to Meta in Facebook, Instagram, and WhatsApp, how much are you going to need, do you think, to have a go at this? And how long can you hold your breath in terms of not having, well, first of all, revenues and then cash flows and profits from doing so? How about in cloud computing? Can you really take on, Amazon and Microsoft in this particular area? In operating systems, are you really going to be in mobile telephony? Can you really get past Apple with 800 million users? Yeah, I mean, there is a degree to which that's true. I think that it is more difficult once these things become entrenched to get by them. Yeah.
Yeah.
I mean, as an investor, my view of that is good, frankly. I mean, I'm not here to make people are not paying me to make moral judgments, by and large. They're asking me to make investment judgments for them.
On the subject of investment judgments, there's been, I suppose, a lot of scrutiny of your kind of buy and sell process in recent times. Morningstar's made some criticism, the kind of timings and buys and sells. And you've kind of acknowledged that yourself when we put it to you. But how has your process been developing there? Do you think you've had interesting lessons in the last year or so?
Yeah, look, I mean, we were very. You're right. Morningstar did say that, but they didn't say. It's rather like I'm on an audit committee for an organisation, and I always rather smile when we get the auditor's letter back from the submission of the draft accounts, because what they basically tell us is what we told them. Except they charged the fee, of course. And it's the same with most of these things. I mean, we weren't sort of pretending that there wasn't an issue in regard to our sell discipline in particular. But we found it kind of difficult to work out a theme. So if I give you some examples, we sold PayPal, Estee Lauder, and Starbucks, all of which were pretty good sales insofar as they've all done badly after we sold them. We could have sold them earlier, though. I mean, every case we could have sold them a bit earlier. Okay. Then we sold Amazon, Adobe, and Intuit, and they all did really well after we sold them. And so, lesson number one would be something along the lines of thinking about this. Well, perhaps we're selling too late. If you look at PayPal, Estee Lauder, and Starbucks, but then we sold too early in the other cases. And I say too early because I think we've been right in the last year or so on 2 out of the 3, which is to say Adobe and Intuit have both performed quite badly now, right? And I think that the writing was on the wall of why they would perform badly as well. In the case of Adobe, their failed bid for Figma was frankly irrational and big and unexplained. And in the case of Intuit, their acquisition of MailChimp is pretty similar. They paid at least 3 times the right price for something which is outside their core competence. And in a telling post-mortem to that, they now don't give you any separate figures for it at all. Well, of course, that's because it's impossible, because it's integrated. No, it's because it's embarrassing, actually, right? And so they've done quite badly. So first of all, I don't know what lesson to get out of that. You could have done these ones earlier, and those ones you should have done later. So I can't find any common lesson. In thinking about it, the only thing I could get out of it was, well, I had probably 2 things. But the main one was, be careful of going when you figure something out, but there is a strong tailwind of something out there, when it's got the zeitgeist behind it. And in the case of Adobe and Intuit, and I guess Amazon as well, actually, but certainly Adobe and Intuit, people were frothing at the mouth about AI and its possibilities for them. I have no idea why, because these basically would be people who would be end users taking the models from the provider of the large language models and using them through the computing infrastructure provided by the Amazons and Microsofts this world, and sticking it on the end of their clients. It's not clear that they could charge enough more to justify that, because after all, they've got to pay all those other people. That's even if it works for them. And so I thought it was premature, would be the mildest way I would put it, to get excited about them and AI. But, it's a bit like, if somebody's let the handbrake off a truck at the top of a hill, it's best to stand out of the way, really, isn't it? That is, I think, probably the best strategy. And so I think in future we will, if we think that we are absolutely right, and I think we were absolutely right about Adobe and Intuit in terms of the fundamentals, we'll go, but is there something going on that we really should just give it time to percolate through a little bit before we get out of the way? The only other lesson would be on Amazon, where you touched upon in an earlier question. Mr. Jassy, a relatively new CEO, saying he was looking for ways to go big in grocery, and us going, that's mad, and selling the shares. What we should have done is wait for him to go big in grocery, rather than listening to what he said. which is a lesson. And it would probably have been absolutely fine to do that because the market quite often is in the mood that a deal is always good. You announce a deal, your share price goes up, even when it's absolutely disastrous, frankly. And so we probably should have waited to see what he did about grocery.
Yeah.
Rather than acting on the moment with it. So look, we've given it a lot of thought. We gave it a lot of thought long before commentators told us that we should have a look at it, and we're still giving it thought now. But it's not easy to get very general lessons out of it, you know?
Yeah, that makes sense. Looking at one of your kind of recent purchases, you've, I suppose, joined some other global managers in holding Atlas Copco, which focuses on things like air compressors. What does it have that kind of other industrials names don't?
I think two or three things. I mean, we are a bit of a sucker for some companies which have got controlling shareholders in the form of foundations and families, because they can be a very good long-term influence. And the Wallenberg family's ownership of this through their foundation and through Investor Arbe has, I think, been a very good long-term influence on it. So, we've got the likelihood that they're not going to be pulled out of shape as a management by the vagaries of what the stock market says, because frankly, their main investor is not going to take too much notice of that. So I think that's a good positive. Also, their manufacturing and management is a bit different to most industrials. They've got a very large outsource input into their manufacturing. They're more of an assembler than a manufacturer in many respects. So that does make you a much leaner organization if you basically outsource making an awful lot of the stuff and just put it together. And lastly, they've got a very widespread delegated management structure. They've got somewhere over 600 operating entities which do make decisions on their local markets, are empowered to do that. Obviously, they do keep central control over certain vital functions with regard to the business in terms of allocation of capital and money and so on and so forth. But that combination of a very good long-term family shareholder, the outsourced manufacturing and the delegated management structure, I think there are interesting combination of factors in there. There was a reasonable write-up recently on the Wallenberg family who are just going to starting the transition to their sixth generation of management of the business. 168 years they've been going at it. It's quite an impressive record.
Yeah. And I just wanted finally to touch on a couple of names that might be too small for you to hold, but it'd be interesting to get your general take, which is Next and Autotrader.
They're both good businesses, good returns. I don't know the Autotrader management at all, but the Next management historically has been very good. For us, they'd be a bit too small, verging on the too small. Bear in mind the size of our fund. We're looking at $1 billion average position size. And when you're talking about buying something which is less than 10 times that size, do you want to own 10% of the company? I don't on the whole want to own 10% of the company, because at that point you really are pretty stuck in terms of I know you can sell it, but it's difficult. Everybody knows what you're doing, or buying more. It's quite difficult. And the other thing is they're a bit landlocked as well. Good businesses which are locked within in the end, relatively small economy don't have the sort of infinite growth potential that we are seeking, basically. The likelihood of developing Autotrader in another country? No, not really. Retail traveling? Well, there have been examples of retail traveling successfully. Fast fashion, I guess, Costco, one or two others. But on the whole, when retail goes across water, it's a disaster. There are very few international, let alone global, retail businesses out there. And so, they're inextricable limits to the UK economy. And their size will probably remember. I think they're both pretty good companies, actually. Yeah, I mean, if I were running a UK fund and it was significantly smaller than the one I'm running, then I think they'd quite possibly both be in it. Yeah.
Yeah. Interesting. Well, lots of food for thought there, but I'm afraid that is all we have time for. So I'd just like to thank Terry for coming on.